All eyes on the European Central Bank decision today, with the ECB expected to raise rates for the first time since 2011. Inflation has been rising fast, and we've reached that point where the ECB just can't sit back and continue to ignore this reality. The big question heading into the event risk is whether the ECB will raise rates by 25 basis points or opt to be a little more aggressive with a 50 basis point hike. At the moment, the odds suggest the ECB will go 25 basis points, but it's a close call, and the market certainly won't be surprised with a 50 basis point move. The ECB needs to consider the energy crisis and the strain on the European economy, but there are signs that things could be looking up on that front, which would argue more for a 50 basis point move. And if we're looking at recent moves from other central banks, including the SNB, a 50 basis point hike has become a norm that only further suggests we shouldn't be surprised if indeed the ECB opts to go 50 later today. There will also be attention on the ECB anti-fragmentation tool designed to prevent fallout by way of different bond yields for different countries. This comes in the wake of a sell-off in Italian bonds, but overall, we think the market will be moving more on the rate move than anything else. With that said, the balance of risk seems to be pointing towards limited upside for the euro, with the greater risk for a letdown and renewed downside pressure as the ECB fails to deliver on hawkish bets. Again, with 50 basis points becoming more of a reality in recent sessions, we think it will be harder for the ECB to surprise to the hawkish side. We also feel Wednesday's much softer German producer prices could also factor into a decision that leans less hawkish than many might be expecting. As far as key levels to watch go, we would keep an eye on 103 and 101. If the euro closes above 103, it will have meant the market is looking at an ECB that has turned more hawkish. If, on the other hand, the euro closes the day below 101, it will likely expose the single currency to deeper setbacks against the US dollar, back down below parity, and to fresh yearly and multi-year